What's up, investors? Certainly not my account. This is the video log that takes 30,000 to a million. I'm going to do an account review and then talk about the markets real briefly, as usual. So straight into the account, I'm sitting at 151,700, which is quite a bit of a loss from my personal highs, and it's also a loss from the market highs, but not to worry. Everything from the 1 day to 1 week to 1 month to 3 month to 1 year to year to date, everything is red. So this is the 1 week, minus 2.48, minus 13 on the month. And I'm going to do a account review comparison of the S&P 500 as well to see where I stand next to it real briefly. And then 3 months is minus 23%, year to date minus 18.5. And then 1 year is 20.86, I think. The all-time chart is still green though, which is good. But this drop off from August 15th has really hurt the account, mainly because some of the generals of the market, i.e. the Apples and mainly my holdings, have finally hit reality and are coming back down to earth, respecting the rate hikes of the Federal Reserve, the United States Central Bank, which sets rate hikes. I mean, they set the interest rate, so the market has to respect it. Someone pretty wise, market investor / operator owner, said once that the interest rates act as gravity to the markets. So a lot of people that are affected by gravity, a lot of companies that are affected by gravity will come down. More specifically, more growthy companies, tech companies with a really large outlook far out into the future, they will come back down to earth. Value companies, not as much, but they will come down. And now that there's a new benchmark and an alternative for investors, they don't have to invest in the market anymore to get some return. I mean, the 2-year treasury note, a treasury note is basically a bond. It's just a different name. Different durations have different names, like bills, notes, bonds, etc. But it's all really the same crap. It's now over 4%. So you can lock your money in a bond, in a note, a 2-year note, and get 4.5% or something like that right now, which is crazy. And not only that, well, what's crazier is that the 10-year is trading at a lower interest rate than the 2-year. Now, riddle me that, Batman, right? How can a longer duration be priced at a lower rate? Well, people are betting that the current actions of the Federal Reserve, i.e. the United States Central Bank, which controls the money supply, is going to cause a deflationary spiral of some sort, or at least a deflationary period where the currency is going to be worth more relative to the goods you buy. That's how inflation is and deflation is measured nowadays. That's how it's defined, which means that longer term treasuries like the 10-year bonds and the 30-year bonds are going to be more valuable. The percentage is going to be more valuable. So it's a strange phenomenon, but it happens. And the bond market is often correct. The bond market traders are often correct on these predictions, which is kind of dire. Okay. They're not always correct. So we shouldn't immediately throw our hats out of the ring and start buying, 10-year, 15-year, and 30-year bonds. That's not what I'm saying. It certainly is an alternative. One could do that. But let's take this commentary on a pause and review the rest of the account, shall we? So, switch to the 1 day because it's more pertinent. I was down minus 0.5%, which actually was better than the market. But the after hours kind of killing me with another 0.44, putting it in line with the market more or less. On the right, you'll see a list of options. Now, if you pause your video player, you'll be able to find out all the information about these options that you ever might need just by looking into this little box right here, full of information. You're going to see everything you need to know. Oh, this one's an interesting one. I'm trying to scoop up some Verizon shares at 35.5. I don't think it will happen by tomorrow, but it could. I could be a proud owner of 100 shares of Verizon at these prices. It's an absolute steal. $35 for Verizon. It was priced $58 not too long ago, and it's a utility. And it's going to last forever. I mean, it's one of the best, most loved brands of mobile data and signal whatever providers. Signal provider. I provide you with signal. Mobile, service provider. Let's call it that. And they're trading really far down, and their dividends huge. And they're not like AT&T where they cut their dividends, every half moon. But they actually keep their dividend the same. So Verizon, it's kind of a steal. This is not a financial recommendation, by the way. Of course, you need to do your own due diligence. I've kind of done enough for 100 shares. I've done due diligence before on this company, maybe like 6 months ago. But I dropped it because I thought it was a tiny bit overvalued at 60. But now that it's 35, I mean, I can't imagine the fundamentals have changed that much ever since. But anyways, before you buy anything, you should do thorough due diligence and research. And in fact, if you're not sure that it's a good investment for you, you should contact a professional. Not your friend who's trading crypto. An actual professional. Okay, so if you're not paying money for it, it's not a professional. Or if you're paying via Venmo to a professional, that's not a professional. All right, make sure they have a nice office that you can go into, and they have the stamp of JP Morgan or something in front of it, or like Merrill Lynch. I don't know, some fancy name. Anyways, I digress. Moving on. These are the options here. You can pause the video player like I said any moment. You'll see there's a lot of leaps on the Chinese ADR VIEs. ADR means American Depository Receipt, which is in fact a receipt for the purchase of a share of a foreign company that you can trade in the United States. It's virtually the same thing as a share for as far as us retails are concerned. VIE stands for Variable Interest Entity, which is a offshore business entity which has a contract with a Chinese national company for the profits or parts of the profits of that Chinese company. And it's honored by the company, no problem, but not necessarily honored forever by the government, which is part owner of that company, whether they like it or not, they must admit. So, as you can imagine, that is an issue with a lot of investors in the international investing community. Whenever you have a governmental influence to such degree, it's tough to do business because at any moment the rug could be yanked from underneath the partnership and all contracts could be void. Therefore, the fear behind Alibaba, behind JD.com, behind VIP Shops, behind Neo, behind Tencent, behind, in fact, any of the biggest Chinese behemoths. And they're huge companies. I mean, Alibaba alone has over 1.2 billion customers. Billion customers. That's more than 3 times the size of the United States. So imagine all of the people of the United States having them as customers. Entire nation. All people in Alaska and Hawaii, even in Florida, Puerto Rico, add them in. New York, San Francisco, Bay Area, LA, the whole entire thing. Oh, the whole Midwest, everybody in the middle. Everyone. Alabama, Georgia, every single state. Take all these people, all these 350 plus million people, multiplied by 3. That's how many customers Alibaba has. This company is enormous. Okay? and it has a third of the market cap of Tesla. Okay, it has the market capitalization, meaning the value of the company, as big of an average US bank. It's absolutely unthinkable. So the discount here for the risk of owning these companies is absolutely enormous. I didn't mean this to turn into like a Chinese company rant, but it's worth explaining. So there's a huge risk. Moving on. Moving on into the account review here. I have a couple of PayPal leaps which might expire worthless. I mean, they're due 2024, so I'm hoping PayPal makes a rebound. I'm not a big fan of some of the recent moves they had when it comes to their policies. I'm sure you can research that on your own or look at a previous video. I might have commented sometime. But you see something very interesting here in the account now, which is that Apple is at 710 shares instead of 700. So I picked up 10 extra shares on margin. You see that Realty Income is well over 400 shares. Picked up some shares on margin. Main Street is well over 900. Picked up some shares on margin. Paramount is at 1200. And I have plenty of options. All of them actually I've covered with call options. Same thing for Smith & Wesson, but I also have some puts that have sold around a $12.50 level. So I will be getting another like 400 shares or so of Smith & Wesson. And then you'll see the newest entrants in the arena here, which are the only two green positions today, JD and Alibaba. Two of the biggest retailers. The reason I picked these two retailers to own if I'm going to own any Chinese receipts is that their retail is the least likely to be pulled away from foreign investors because they contain the least amount of state secrets or whatever the Chinese government thinks they're protecting when they're preventing their companies from listing abroad. So we'll see what happens here. S&P 500 actually was down 1.17%. I didn't realize it dropped down low. So let's compare the S&P 500 via the SWBI, which is an exchange traded fund, which tracks the top most profitable, largest companies based in the United States. 1 day performance. Oh, it's including the aftermarket. That's why, the after hours. 0.83. So let's compare that to my 0.44 down. That means I'm beating the market today. However, let's take a look at the week. Minus 1.18, whereas I'm sitting at minus 2.46. So losing there. I've got a minus 13.05% month versus the S&P sitting at minus 5.71. So you can see that S&P outperformed my account by threefold in the last month, which is a huge, enormous underperformance, but not to worry. On a 3 months rate, the market is at minus 7.2, whereas my account is at minus 23%. Again, about more than a threefold decrease here. Year to date, 18.47. The S&P 500 year to date doesn't say. Okay, let's do 1 year. 1 year is 19.27, whereas my 1 year is 20.86. So about even, underperforming by a slight bit on the year basis. And then lastly, I'll show you the all-time chart because everybody loves to watch that. I'm up 110% all-time. Started investing somewhere here in August 28th, 2018, when I had almost no money here. But now I have some money. So not bad. Doubling in 4 years still, even including this past decrease. If you're wondering what the high was, it was scored somewhere around here at August 8th, between 8th and 15th. I had a day where the account was sitting at 214,000. So that's the all-time high. And, you know, I'm optimistic I'll get there eventually. It might take a while. But We'll get there. We'll get back to those levels. No worries. Investing tab. Sitting on a total money under management of $264,813.40. So that's actually a lot higher than a month ago. And the reason for that is because we're operating now with 113,000 worth of margin. So I'm trying to, I had a conversation with a friend about this, right? Let me just finish and I'll show you. So this is the margin here, almost maxed out. The rest of it is actually in options collateral, so I might be more than maxed out by the time tomorrow finishes. Hopefully it's a green day. Although it doesn't look good by the fall of Snap. Did you guys see the Snap fall? That was crazy, right? Down 25% or something after market. Then Facebook another 6%. So tomorrow might be pretty ugly. Actually, we'll see. Not entirely sure what's going on there. Okay, by total return, only Apple is green. We'll eliminate JD and Alibaba from the equation for right now. Everything else is pretty red. Smith & Wesson is down almost $22,000. By equity, Apple's number one at 101,000, then Smith & Wesson at 81, 82. Main Street Capital, Realty Income, Paramount, and then Alibaba and JD rounding out the bottom. The newer entrants in the arena. Okay, so that is the investing tab. Now, I want to talk about a bit about my craziness, right? My crazy situation. Oh no, the margin, right? The crazy margin. Why would somebody put so much margin in the account? And at this, risky falling market, high volatility market, where anything could happen, and we're about to have, housing and banking crash, and housing is going to a halt. The market's frozen, prices are falling, and inflation's roaring, eating up all the margins from all the companies. The earnings are dropping. It's depression time. Well, first of all, I don't think it's that crazy to be actually buying stuff when the market's giving you 25% discount. Would you rather buy something at full price or a 25% discount? I don't think it's crazy to take more risk now than if it were at the top. It's really easy to point at somebody who's all margined up at the top and things have been going great for a year. Let's say during 2021, right? During the summer of 2021 or something, late 2020 to 2021. And looking like, oh yeah, the right move in retrospect, of course, it was to leverage up. Like, why would you not be levered into this market? Money's flowing like crazy, stimmy checks, right? Money flying everywhere. PPP loans, $500,000 to this business, $500,000 to that business. Everybody's putting their excess into stocks. Everybody's getting rich, blah, blah. No inflation. This is the best thing ever. And now that it's the opposite, people say that you're crazy for levering up now. But I think the crazy thing is to be levered at the end of 2021. When leverage on the overall market shot up through the roof. And I thought that was the crazy part. I was trying to reduce leverage. I didn't get as low a levered as I'd like to eliminate, go back down to zero. But I only had $10,000 in on margin. Right now it's 110. Okay, but I'm doing it. I'm trying to do it as proportionate to the market drop, right? I'm trying to lever up more as the market drops and trying to reduce leverage as the market goes up. I think that's the sane thing to do. If you disagree with me on that, then I want to hear your arguments as to why is it a bad thing to do that. Doesn't it make sense? Don't you want to buy low and sell high? Or am I missing something here? Why are we reducing risk as the market keeps falling? That doesn't make any sense to me at all. You should be increasing risk. You don't want to be increasing risk at the top, right? If I put it that way, then it makes more sense, doesn't it? Why would you increase risk at the top, right? It's like you have further to go. for it to go. The risk now is to the upside. It's less risky, I think, to lever now than if we were at all-time highs, just riding the top of the wave. So I don't know. Let me hear your argument. If you disagree with that, let me know in the comments and tell me why I'm wrong about this. All right. I'm going to end it right there with this fruitful discussion and a question for you. Let me know in the comments. Peace out.